Time now for an in-depth look at the market news this afternoon, and for that I'm joined on the line by Dr. Kim Sei-wan, professor of economics at Ewha Womans University. Professor Kim, good afternoon. Thanks for making time today.
Good afternoon, Devin.
The latest Beige Book from the Fed shows the U.S. economy picking up speed in the past couple of months. It seems there's also more upward pressure on prices, including the price of lower wage labor. And this is the kind of thing that's been fueling talk of the Fed tapering its bond buying. Tell us about the Beige Book and what it means.
U.S. inflation stayed around 1% level all last year. But as U.S. economy recovers from pandemic, inflation is picking up quickly from the beginning of this year. April's annual inflation increased up to 4.2%, which doubled Fed target inflation rate for this year. U.S. Fed still maintains their view that rising inflation will be temporary, and there's no reason to discontinue zero interest rate policy. However, according to a recently released Beige Book, which is the official economic trends report of Federal Reserve, it admits stronger inflation pressure and wage increases, which raises inflation further. And the Beige Book mentions more about tapering or less money supply. This is a significant signal of closer tapering and interest rate increase by U.S. Fed.
Right, and turning to the markets, stocks on Wall Street were higher Wednesday ahead of jobs data for May. Investors are also pumping the so-called meme stocks again, like AMC movie theaters. Tell us about that and the overall story in the global markets.
New York market slightly gained yesterday with a 0.1% return in both the Dow Jones Industrial and NASDAQ. High expectations and robust U.S. economic recovery and higher oil price are dominating investors' psychology now. So it made higher returns on energy stocks yesterday. Meme stocks, which follow investors' fashion trading, skyrocketed yesterday. For example, AMC, a movie theater chain, stock increased by 100% in a single day. European markets over London, Frankfurt, and Paris all increased over 0.2% to 0.4% due to stronger expectations on economic recovery in European continent.
And back here in Korea, stocks were higher today, too. We can see a renewed interest in local SPAC offerings, for one thing. What's happening here in the domestic stocks?
Domestic market had a great performance today with 0.7% return in KOSPI and 0.9% return in KOSDAQ. One thing particular in today's market is foreign investors became the market driver with very aggressive purchase. Domestic investors, on the other side, sold domestic stocks today. As mergers and acquisitions news increases in tech companies, SPACs increased in large scale today, too.
Right, and zooming out, Professor, for a minute, last month data show consumer prices in Korea were up 2.6% from a year earlier, and that was the biggest on-year rise in 9 years. In large part, higher grocery prices, but oil prices also a factor since they were so low a year ago. The government thinks this will settle down later in the year, but what do you make of the concerns out there about inflation?
If we take a look at economic environment of Korean economy, there are lots of factors that increase inflation. Bank of Korea's 0.5 base interest rate with unlimited liquidity supply, and quickly increasing oil price and other raw material prices are raising domestic inflation. Last month, May's 2.6% inflation is well over Bank of Korea's target inflation rate of 2%. Bank of Korea and government's understanding is that this higher inflation will be temporary, but there is still a concern that this higher inflation will be continued due to faster recovery in domestic consumption and export.
And now there's talk in South Korea by the ruling Democratic Party about the need for a possible second extra budget this year to fund more support for people who are self-employed and others who've been hit by the pandemic. But again, this would have to be funded by debt. And again, there's the inflation issue. Well, what do you make of the situation, Professor?
Well, because there are lots of people still suffering from pandemic, it is necessary to further stimulate economic with physical support of government. But it is also true that government debt increases very quickly with government debt to GDP ratio, which is 50% until next year. Foreign sovereign rating companies like Moody's and S&P are pointing out that quickly worsening government debt situation could be one of the largest risk factors to Korean economy in the future. So that means that government, particularly Department of Economy and Finance, should be more responsible against Congress' strategy of easy government money use.
Well, we'll have to wait and see what, if anything, they come up with for that second round this year, Professor. Thanks so much. We'll have to leave it there. Thanks so much for sharing your insights with us today. We appreciate it.
Thank you, David.